Soji Omisori, and I'm Deputy Director for PSF, Private Sector Facility for GCF. So today's session is about greening the financial sector. So I'll very quickly, I'll talk about a little about us, but the opportunity is more for my panelists to my left, to actually provide some of their own kind of thoughts and experience of what they're doing and how that relates to the topic today in terms of financial institution. Thank you. So at a glance, GCF is the largest multilateral, fund in the world. We drive paradigm shifting, and what I mean by that is, we don't look at projects on a kind of one-by-one basis. We look at it in terms of a pragmatic approach and trying to do things at scale. And we look at transformative changes, in climate finance to create co-investment opportunities. We're a hub of the climate finance architecture, and we also help to de-risk projects to address the needs of most vulnerable countries, as well as LDCs, Africa, as well as SIDS, Small Island Developing States. And we're a partnership organization, and GCF is putting forward co-investment initiatives and platforms to accelerate climate innovation and investment at scale. In terms of funding, to date, 2022, we have dispersed about $3 billion, and in terms of implementation, about $9 billion. So, in terms of the private sector, it was approved that B32 March last year. And that was kind of transformative for us. And as you know, we're a public institution, but due to the size of the climate issue, we know that obviously capital is with rising inflation, when interest rates are going up and capital is becoming more constrained, our cost of capital is going up, and from the public's purse, we know that that's also decreasing. And therefore, we need to look at alternative sources, and the private sector is obviously one of the largest partnership in terms of trying to galvanize and catalyze funding. So, for us, the private sector, PSF strategy was created in order to enable us to achieve, our private sector goals. So the idea is to promote conducive investment environments, for climate and economic growth, to accelerate innovation for business models, financial instruments, as well as climate technologies. Importantly, to also de-risk market-creating investments and crowding, private climate finance, and lastly, to strengthen domestic and regional financial institutions to scale up, private climate finance. So we do that through, blended finance, and we take high-risk concessional funding in the sense that we take a lower return in order to ensure that the private sector that come in, they have a slightly different, market return expectation, that they're able to meet their market expectation, and we provide a concessional funding, so we take that lower return. In terms of the instruments, we provide, historically we've provided debt and grants. Those are the core financial instruments that we've always provided. However, with a more focus on adaptation, with more, guarantees and equity in order to take early stage risk. Of course, whilst we are a kind of implementation and partnership organization, we're also a learning institution. And I think it's important, to provide an opportunity for my panelists here to share some of their learning kind of opportunities for us here to see what we've been doing well, and also share some of the things that we need to improve upon. And in terms of who my panelists are, Avinash Prasad, he's the Chair, CARICOM Commission of the Economy. He's a professor
And so you find that banks end up converging to things that are safe and they're attractive capital requirements. 90% of bank lending, 90% of bank lending is on three things alone: mortgages, car loans, and credit card loans. And that is, the mortgages and car loans have low capital adequacy requirements. The credit card don't, but that's why they charge you 28% on your outstanding balance. Please don't run large credit card balances. And they're charging you 28%. They've got a high capital requirement on that, but they're charging you a lot of money for it. So that's what they do. So along comes very attractive green climate opportunities. In Barbados, where I'm based, we have one of the most attractive feed-in tariffs in the world. If you have sufficient capital, you can make something like a 12% rate of return just by taking a 20-year contract on the return of the energy you've pumped into the grid. And that's without really taking much risk. So you would think everyone will be doing it. But in fact, our banks are very conservative because they'll say, I know how to do mortgages, car loans, and credit cards. And when I start doing a new loan, I need to be able to persuade the regulator that I know the risk of this. I know the default rates because of my history in lending to these things. And that if there is a default, I understand the collateral. And the collateral is not based on a government policy contract based on a government policy for 20 years, which is over the life of, say, 5 governments. So the riskiness they perceive is higher, we would say, than the reality. And you've done some work on showing how the risk is quite low, but their perception is the risks are really quite high, so they don't lend. So that's why we're partnering with the Green Climate Fund to establish a blue-green investment bank in the Caribbean. And really what we're doing is to be catalytic, is we're going to show the banks what they should be doing. And we're going to show them that actually doing this is much lower risk, better rate of return, but we're not going to go after depositors to fund our bank, so that we can actually have more flexibility in showing what makes a great rate of return. So we have a plan, and just a week ago, this was our application was passed by the Green Climate Fund's board, and we hope to start next year. The funding application was passed by the Green Climate Fund's board, and we hope to start next year. So a major part of what we're going to be doing is investing in some of these renewable energy projects. Let me describe one of those projects to you, and touch on a second, and then invite the other panelists to join in. So we have a project in the Caribbean, I think quite a iconic project we call the HOPE project. And HOPE stands for Home Ownership Powered by Energy. And this is renewable energy. So we have a problem where we have not only homeless people who the government needs to support with social housing, but we have a lot of people on low incomes who are paying very, very high rents, but they don't have a big enough income for the mortgage companies to give them a mortgage. So we have decided that we're going to give them a piece of land, and the land will be worth 25% of the value of a constructed home and the land. And they're going to go to the mortgage company with now 25% of the value in collateral, and the mortgage company will lend to them. We've worked with the mortgage companies to do that. And in return, they're going to lend us their roof. And we're going to put some solar panels on the roof, and we're going to put it into the grid, and we're going to actually fund the land we've given them for free over 15 years. And the beauty of this project is that it allows us to recycle this over and over again. It is a self-funding project. So we originally started off with $30 million that would only build 100 social houses in the Caribbean. Our people have high expectations. But with this project, we can now build 10,000 homes and eradicate our problem of the of those people who have some income but not enough income to own their own home. We are giving them collateral, giving people who have never had collateral before in their lives collateral, having a sense of ownership. They can own something. They've never really owned something of that size in their lives before, all possible through renewable energy. But we needed the banks to fund that, and the banks were not. Even though there was a 20-year contract from the Light and Power company, and the Light and Power company, Canadian-owned company, has a higher credit rating than the government of Barbados. But even so, no one wanted to fund that. So the Green Climate Fund with the Green Climate Bank is going to fund that, show how it can be done, and hopefully encourage all the other banks to join in afterwards. Thank you very much.
Thank you very much, Avinash. Thank you very much, Avinash. It's good to hear about the hope opportunity, and that's exactly what we're trying to create. And we hope that by helping to green financial institutions in the countries of our focus, that we're able to achieve that. I'll now hand over to Lasita. Thank you.
Is it on? Thank you. Thank you very much, Soji. Right. So Avinash has been talking a lot about the importance of local capital markets and mobilizing local capital. Now, with the Green Guarantee Company, we have a simple point to make, which is it okay? All right, thank you. Sorry, apologies. Thank you. Which is, okay, firstly, I need to explain something. Before I started doing this, I spent more than a decade running a guarantee company that focuses on developing local capital markets. I am a passionate believer in the need for developing local capital markets. The simple fact, however, is that even if we, I don't know what happened there. Here we go. Even if we mobilize every dollar of local capital that there is, it simply wouldn't be enough to meet the climate finance gap. That's the reality we are in today, right? So what do we do about that? Well, there's a much bigger pool of capital sitting in global capital markets, over $100 trillion, but very little of that is coming over into developing countries. And fundamentally, that's the issue that we want to try and understand a little bit better. Now, there are a lot of layered issues around why that global capital isn't flowing in to developing countries. But one key issue is that investors essentially have a perception of risk. And one of the key things that drives that perception of risk is credit ratings. Credit ratings are issued by mostly global credit rating agencies. Those are the ones that global investors pay attention to. And sometimes they work, sometimes they don't. I think Avinash gave an example of where they don't work, where you have a highly rated entity and it still wasn't mobilizing money. Fundamentally, however, though, one of the challenges is that you also need to be in their face all the time. One of the things that we see as an absence in global capital markets is an advocate for developing countries who are sitting there knocking on the door of global investors saying, why are you not investing? Here we are, we're happy to try and support this as well and put our money where our mouth is. This makes sense for you to do. And by the way, we can make this investment grade. So fundamentally, a lot of that money on this slide is showing is sitting in for investment grade climate opportunities. Emerging market climate projects are classed as sub-investment grade. Now, Moody's, which is one of the credit rating agencies, they've actually done a piece of analysis where they've looked at the risk of climate infrastructure over the last 10 years. And what they found is that actually the probability of default on a climate project in an emerging market, and this includes all developing countries under this, is actually the same as same risk of default as in a developed market. So what that actually fundamentally means is that investors sitting in global capital markets are misunderstanding the actual risk of climate projects in developing countries. And this information, when you mention it to global investors, it's new information. They're like, wow, we didn't know that. Well, how many of you actually got off and actually spend the time to look and find this information because it's there on Moody's website? Well, frankly, we've got budgets to meet. We've got easier things to go and invest in. We need things that are easy for us to understand. And again, that's where a guarantee can help. Basically, by providing the guarantee, what we're trying to do is two things. One is we're trying to give a stamp, a visible stamp on there that this is now an investment grade opportunity to a global investor. But equally and more importantly, what we're going to try and do is, over the relationship of providing that guarantee, is keep reporting to investors about the climate impact of that project, but also about the actual risk of that project. Our fundamental thesis is that over time, as we build the capacity of global investors to understand the actual risk on the ground, they won't need guarantees anymore. And actually, we have lots of examples from the past of where we were doing guarantees where that's been the case. In fact, actually, if you look at the US, it's a great example. In the 60s and 70s, no investors were investing in infrastructure in the United States. It's very hard to believe that, but it was actually true. They created an industry called the monoline insurance industry, which is basically guarantors who guaranteed bonds issued by infrastructure projects. That industry no longer exists because it doesn't really need it anymore, right? All infrastructure is being invested in by investors without guarantees in the US, because as they became more familiar with the asset class and understood that risk, they said we don't need the guarantees anymore. Now, from a climate perspective and looking at the developing world, there's just so much there as an opportunity that I think this is something that can, we can grow this over time. But fundamentally, here we go. One of the things that the beauty of the guarantee is it's a promise to pay. So it can actually be delivered very efficiently. So for $1 of capital, we can provide $10 of guarantees. But now, over 10 years, we can actually recycle that guarantee capacity. So actually, on our calculations, we can provide 16 times more climate finance over a 10-year period through the guarantee mechanism. So this is where guarantees are incredibly efficient. They can be incredibly helpful. And obviously, we can deliver a lot of climate potential as well, impact through that as well. And we're estimating that over 10 years, with a $4 billion guarantee capacity, we can issue 75 million, we can mitigate 75 million tons of carbon dioxide and it'll help over 17 million people. Now, that's $4 billion based on a $400 million investment of capital, right? So from our perspective, that you can't really get more efficient than that. And that's where we see the opportunity lying. Everyone is saying there isn't enough capital. Well, there is plenty. You just need the right mechanism. So we see guarantees being quite a core mechanism for that. We've had a lot of support for this. We're very lucky to have the support of the UK government as well through their Mobilis program. We've been endorsed by the Global Innovation Lab for Climate Finance recently as well. And we're also very pleased to announce today that the Green Climate Fund has become our founding shareholder, and we'll be making an announcement shortly around that as well. So thank you very much. I'm going to stop there.
Thank you very much, Lusita. It's good to hear in relation to what you're doing in terms of the green company guarantee, green guarantee company. And I think it'd be good to hear now, from one of the local banks, from Tanzania, who can actually give a first-hand perspective in terms of what they're doing and how some of the challenges and some of the opportunities that we've highlighted can actually be realized. So I'll actually hand over now to Kenneth. Thank you.
Okay. Good morning. Thank you very much, Soji, for very good introduction. And also thank you very much, my fellow panelists. So my name is Kenneth Kasigila. I'm from Tanzania. Can you hear me? Good morning again. Thank you very much. My name is Kenneth Kasigila. I'm from Tanzania, from one of the largest commercial banks in Tanzania. So we joined the race seeking for green financing on various financial instruments to Green Climate Fund 2 years ago. So the journey took us about 2 years until we got the accreditation. And after the accreditation, we started formulating concept notes and funding proposals. And I'm happy to inform you that so far we have one funded proposal financed by GCF worth $100 million of GCF financing and also we co-finance $100 million US. So in terms of the institution that I'm coming from, it is CRDB Bank, registered in Tanzania, and we have bank branches in Burundi, and we are also about to open another bank branches in DRC Congo. So we have been rated by Moody's, and we are also been registered and also listed at the Dar es Salaam Stock Exchange market. Excuse me. Okay. So far, we are the only commercial bank that has been accredited by the Green Climate Fund in Tanzania. And by the time that we were accredited, we were the only commercial bank in East and Central Africa. And as you might be aware that so far in Africa, there is only 4 commercial banks, if I'm not mistaken. So CRDB Bank is the only commercial bank that has the funding proposal approved from GCF. As much as we came late than other commercial banks, but we were able to mobilize our resources, working hand in hand with GCF, and we were able to get their first funding proposal approved in 2020 last year. In terms of our business banking in Tanzania, we are the largest lender in agriculture. We command about 40% of the agricultural sector in Tanzania. Tanzania has more than 50 commercial banks so far. So in terms of the balance sheet, we are the leading on the agriculture sector. So I'll quickly jump to our recent funding proposal that was approved by GCF. As you can see, it is Tanzania Agriculture Climate Adaptation Technology Deployment Program. It's funding proposal number 179, and approved in 2020. So in a nutshell, as I've mentioned earlier, so total financing is 200 million. 100 million is coming from GCF, and another 100 million is coming from CRDB Bank. So we co-finance the $100 million. So our main focus is on the small orders farmers located in Tanzania. And our expectation is that the implementation period will be 5 years. And also the grace period is going to be 5 years on our operations. So in terms of the beneficiaries that we're expecting to reach is 6.1 million smallholder farmers, broken into 1.2 direct beneficiaries and 4.9 is indirect beneficiaries. So as I'm talking right now, we have already signed the funded activity agreement, and we are trying to address some of the conditions attached to the funding proposal so that we can start receiving disbursement by end of the year. So in terms of the key components of this funding proposal, our main focus, as I've mentioned earlier, we are focusing to address the challenges that smallholder farmers are facing to unlock their climate resilience activities, and also to transform their activities on the adaptive capacity to transform the Tanzania's financial sector industry. So one component is on the transformative financial products coupled with the guarantees, insurance components, and affordable loans. So by the time that we are writing this funding proposal, the research that we did, we found that the smallholder farmers are being highly charged in terms of the lending rates. So we are coming in working with the GCF to lower the lending rates. And we expect the lending rates will go down by more than 60%. So most of the farmers in Tanzania, I think they more or less the same than any other African countries. They are facing huge challenges in terms of guarantees. They do not have collaterals. So whenever they go to the bank, they are missing collaterals. So we are working with the GCF to unlock this barrier with the guarantee facility of $10 million. And we are also working hand in hand with GCF to provide the innovative insurance package for smallholder farmers. I don't know in the other countries, but in Tanzania, like many other African countries, most of the farmers, when they face climate challenges like drought, floods, etc., they ended up losing their financing. So we are working with the GCF to have the specific insurance package to finance these local farmers on the insurance package. So as you can see that the insurance package is $10 million, the guarantee facility is $10 million, and the adaptation credit lending is $70 million. But we will also co-finance the additional $100 million. In terms of technical assistance and the policy intervention, during the research that we did, by the time we were writing this funding proposal, we found a lot of barriers or challenges that public and the private sector are facing. So we've worked through, hand in hand with the GCF, trying to identify some of the challenges that public sector and the private sector is facing. So there will be specific package for policy intervention and also capacity building. So the total package of technical assistance is $10 million. So I've explained about the total beneficiaries that we are about to reach in Tanzania. The total number is 6.1 million beneficiaries, broken into direct and indirect. So the beauty of this facility is that the lending rates will go down by almost 60% to ensure that smallholder farmers get this access of financing that they've been missing for years. So the agriculture program that was approved by GCF, it's already history and about to be implemented. So this is the list that we are working with the GCF as a pipeline or wish list. We've already submitted the concept note on the mass transport, on bus rapid transit. We are working with the government of Tanzania closely to extend the BRT that we are having right now. We've even submitted the draft concept note to GCF on the blue economy, but we've also submitted the draft concept to the GCF on the greening sugarcane industry in Tanzania. We're also working closely with the revolutionary government of Zanzibar to develop the solar renewable energy. We've even submitted this one, and we are still engaging with the GCF, trying to improve on how fast we can access another approval to GCF. But we are also working closely with the GCF to develop the geothermal source of energy as a renewable energy. So again, we have a number of engagement with the GCF. We are yet to develop the smart villages, but all preparations are in place right now. So what we are doing is closely in line with the government initiative. We have very good document in Tanzania in terms of the plans and everything. So we've just finalized our 5 years climate change strategy and also the National Financial Sector Master Plan. So CLRB, we were part of the technical team during the preparation of these documents. So what we are looking, not only to GCF, is the long-term financing that we can finance a number of projects based on the public demand and also private sector. Another issue that I had another slide, I think. Anyway, so this is what I've prepared for CLRB Bank. Unless if there is any question, I'll be happy to respond. Thank you very much.
Thank you very much, Kenneth. I think we've now heard from our three panelists. It's good to hear from a vision in terms of some of the challenges that they're having in Barbados and how they're trying to help to catalyze opportunities because of the reluctance or risk aversion provided by the banks. So they're trying to address it in another way through the HOPE program. Lasita mentioned in terms of how we are trying to use guarantees to breach the sovereign risk rating, i.e. the opportunity to access funding that at a lower price than you would for the country in which the project is based in. And he articulated that very well. And Kenneth now has provided kind of examples from a debt as well as grant perspective in terms of what they're doing in Tanzania. So I hope that provides a kind of a broad range in terms of the way that GCF works and how we hope to green financial institutions in the markets that we operate in. I want to make this session an interactive session. So, if any of you have any questions, please share those. In order to kind of take things forward, I'll ask the first question, and then I hope some of you are more engaged and will ask subsequent questions. So in terms of the first question, what are some of the barriers in greening the financial sector and accessing local and regional international capital markets? And what are the possible solutions regarding how to address them? So I think, Lasita, maybe you can answer that first, and then
Sure.
we could go to Avish and then Kenneth. Thank you.
Okay, I think, look, fundamentally, the biggest barrier is the information barrier, right? It's information asymmetry, which means people, in the absence of having the right information, they make the wrong assumptions about something. And what we are seeing, and what I have seen in, as I said, I've been working in emerging markets for well over a decade now, has been that people don't fully understand the risk on the ground. And they therefore attribute either a high cost to that risk, or a higher cost than is accurate, or they simply don't make the investment at all, right? Now, fundamentally, to address that gap, you also need to have the capacity on both sides, one, to understand the risk on the investor side, but on the side of the project or the borrower side, you need to have the ability to understand how to get that information, to package it in the right way so that it makes sense to the investor and deliver that, i.e. you need to learn how to communicate effectively with that. This is one of the biggest barriers, right? In any relationship, communication is the biggest barrier. This is what we need to find a way of getting right. However much money there is in the world, until we can talk to each other effectively and get people to understand what the actual risk is in developing countries versus the perceived risk, we're not going to change anything. So that, from my perspective, is one of the key barriers to getting more financing flowing.
I think that's a very important point, but I believe that information asymmetries aren't the whole story. And I think the way I would think about this is, if you're looking at Japan, Greece, Italy, they have some of the lowest borrowing rates in the world. Their borrowing rates are far below anything in Africa, and yet they have some of the highest debt to GDP ratios. They have, you could hardly say, and I no disrespect to any British, Italian, or Greek friends in the audience, but they don't exactly have a great amount of political stability either. So somehow they're managing to have very low interest rates despite having a fair chunk of risk. Why is that? And that's not just because of informational asymmetries and we don't know the risks in other countries. It's because they issue international reserve currencies or have access to them. It means their ability to issue more currency without their currency collapsing because there's an international demand for their currency. They have more by being able to issue an international reserve currency. They have a wider set of options when risks happen. In the United Kingdom, there was a major liquidity crisis. The Bank of England was able to come in with a guarantee. No developing country could do that. So they have a different range of options. And I think that if we want to lower the cost of capital, we have to attack the informational asymmetries, and we have to do something else as well. And the way we do it is also through what you've been doing, through donor guarantees. So the cost of capital is the big challenge. Developed countries borrow at 3 or 4%. The average developing borrowing rate is 14%. That's the average. So many are borrowing at 20%. Add on that the private sector risk premium, the country credit rating ceiling, that cost of capital is too high. So we need to bring it down with risk mitigation, with insurance instruments, with better information. But also, we believe we need structures that introduces the donor guarantees that brings down these cost of capital. And that's what we call a global climate mitigation trust. It's a key component in the Bridgetown initiative that you may have heard us pushing in recent weeks. And we think it's a key way of driving international private sector into projects in developing countries. Thank you.
Thank you very much. In addition to what my colleague, I think access is the major barrier. So, for example, basing on what we have done in Tanzania, when we started the journey on the green financing, access to finance was the major issue. And our biggest hope was that the agreement, the 100 billion US dollars pledged per year, has not been realized until today. So looking at the GCF, there is only 4 commercial banks so far that has been accredited by GCF. So you can see that the commercial banks, they are lagging behind on the race. Looking on the central bank, how many central banks, let's say in Africa, are they following the Green Finance Initiative? Very few banks. I was looking to Tanzania, national determined contributions. From our plants alone, we need like 5 billion US dollars to realize our NDCs. In East Africa alone, on the adaptation initiative, I was reading one of the UNECA report the other day. It says that the needs for East African countries alone, we need about 157 billion US dollars. But looking to what we have achieved so far is less than 10%. So access to finance to me is one of the major barriers. And also awareness. There is very low awareness on the public in regard to green financing. So you can see that there is a lot of money moving around, but very little amount of money is being geared through through the green financing. So awareness, I think, is also one of the key area whereby you may find that if there is a good knowledge on the green financing and what to do, I think we should be able to mobilize the required amount of financing from private sector and also from the public sector. Thank you.
I think Nash provided me with a fantastic example, right? And I'm hoping, but the recent turmoil that the British government experienced in the financial markets, fundamentally, people have assessed it as failure of poor communication, right? So even developed governments can get it wrong. You need to be able to communicate with investors in a way that they understand and they feel comfortable with. Otherwise, we've seen examples of that, right? So nobody has to monopoly on getting this right. It is something that we have to do constantly and work. And I'd like to give you an example. I have the pleasure of actually having sat with Kenneth a number of years ago and provided CRDB Bank with a guarantee. And it was one of the easiest transactions to do because the quality of information CRDB Bank was able to give us. In fact, I think you have the distinction of having a lot of international investors in CRDB Bank is because they got that right. They focused on getting their information delivery and communication right. And this is the power of getting that right. So while it's not the only barrier, I think it is one of the most significant barriers to getting access to finance.
Thank you for that. Any questions from? Excellent.
Thank you. My name is Rob Probyn. I'm from the UK government. And Laz, just to say, delighted that our Mobilist program is supporting GGC. So I had one question, which Avi, I think you've probably already partly answered actually, which was, it was interesting to hear both of you talk about risk misperception as one of the things we have to address. And my first question was going to be, is that the biggest barrier, or is there real de-risking that has to happen as well? And Avi, you've kind of already addressed that actually. So I guess a follow-up question, which is more directly for Laz, is about, you talk about a 10 times potential multiple, the ability of GGC to leverage its equity. Could you tell us a bit more about what you see of kind of institutional investors kind of real willingness to take a bit of risk. So anyone can invest if you've got a guarantee which takes you up to AA, AAA rated. What do you see of kind of investors, as I say, real kind of appetite to invest and take some new risk? Thanks.
Thank you for that. Whilst we're on this topic of risk, now I think it would be good to add one further question, if you don't mind, and that's in terms of what in the capital markets and foreign exchange markets at the moment. We've seen a lot of huge amounts of volatility and what we call a flight to safety, i.e., to the US dollar, and the impact on that on emerging market currencies is that there's been huge kind of fluctuations, i.e., depreciation. And I think in terms of some of what we're seeing from our project's perspective, it'd be good to hear your thoughts in terms of why or some of the challenge you see from in terms of providing foreign currency investments vis-a-vis local currency revenues, and how to manage that.
Thanks, Rob. Always asking me the easy questions. No, look, we've spent a lot of time, and I know the UK through the Mobilist program, I spent a lot of time talking to institutional investors about what their challenges are in investing, and I do think there is a growing realization, particularly around climate, that they need to come off the bench. And so from that perspective, there is increasing appetite and to look at investing. The challenge is nobody wants to be the first, right? Because if it goes wrong, nobody wants to be the one that says, oh, you were the dumb one to do that, right? And that's where we kind of need to find a way and create structures and mechanisms. And de-risking can happen at the project level. You can create lots of different ways of de-risking a project on the ground, or it can happen at a market level. And what we're talking about is trying to do that from the Green Guarantee company perspective. We're trying to do that at the market level, is create structures where you can build portfolios of risk. So you're not taking risk on one single project, but multiple projects, and creating that. And investors are more receptive to that, is what we're finding. So we are trying to create those pathways for investors to look at things. And the key thing in this is to make it look like something they've seen before. When you present an investor with something completely new, in a new country, in a new sector, so on, they will struggle to get comfortable with that. The more you can make it look like something they've seen before, the easier it is for them to say yes. And one of the skills that we hope to bring as a guarantor isn't just the guarantee, because we ultimately have to take that risk ourselves. That's what we're guaranteeing. We need to be able to structure that risk in a way that makes it look simple and easy for the investor to understand. And if we cannot, then the guarantee comes in and says, you know what, if we have got this completely wrong in terms of the way we structure this project, we ultimately are prepared to put our money where our mouth is and take that risk. And that is what I think will ultimately make that change, which is basically showing that we're prepared to share that risk with them and take them on, come on the journey until the point they say, you know what, we've got this now, we don't need you anymore. So I hope I've answered the question, Rob.
Well, as you said, Rob, I sort of answered it already. I mean, I think that we teach what LAS does, which is the sense that we teach that the world has risk, and the different interest rates or yields are a function of the risk. And therefore, if you can risk mitigate, you can bring the risk down. But, you know, we're not new to this, and there's a revealed preference. It's not working. It's not working to mobilize the size of capital that we need. We need huge amounts, trillions of dollars, $2 trillion of investment. Very recently, there's been a $70 billion outflow of emerging markets. So we need to do all the things LAS is doing, and we need to do that more comprehensively and more substantially, and we need to do other things too that fundamentally bring down the macro risk. So one of the reasons why all the volatility in currency markets you're talking about is that markets know that developing countries have much less room for maneuver. That faced with rising US interest rates, there's not much they can do. They try to defend their currency. US interest rates go up, their currency goes down. They try to defend their currency with higher interest rates. The market says, you can't do that. Keep on doing that because your economies are weak. And so your currency goes down even further. And that's an environment where there's no amount of private sector risk mitigation is going to solve that problem. So you need to do it. It's very important. We could debate whether it's half of the risk or a third of the risk. But the point is that to get it down to the levels that will draw in the capital we need to do other things too. And the UK has played a great role in helping with the donor guarantee. And we believe we need structures that will create this to a much bigger scale. If you like, take LAS and multiply him by 1,000, 10,000, because we need a much bigger scale that projects can go to get that low-cost funding and off countries' balance sheets and off local projects' balance sheets, because you've got country credit ceilings. So a third-party entity that's not in the country, that's lending the money with these guarantees, the project is outside, and that will give them the high credit rating and the lower risk, I think. So it's a combination of these two things that we need. Neither one is enough.
Excellent. Can you hear me? Thank you very much for that. I hope that answers your questions. Any further questions? We only have like 2-3 more minutes, so we'll take one more question, and then that's it. Thank you.
Thank you very much for very good information that I received and I learned from here. As for my understanding, that at least two of you mentioned about the barrier or challenges of the information flow from the donor country to the project levels. This is a real gap that I can see. But my easy question maybe is for also GCF as well. Do you have any strategic plan in order to fulfill that gap, in order to ensure that developing country can access to or understand the information on the financial flow from the global level to the project levels? Thank you.
Thank you very much for that. I think our creation as GCF was in order to channel financial flow north. Can you hear me? Okay. Yeah. The idea is the whole concept of GCF is to channel flows from the global north to the global south. So that's our reason for being. We do that in many ways, as I highlighted, right at the start. Historically, we've provided debt and grants, which make up about 82% of our portfolio. Over the last couple of years, we've focused a lot more on equity and guarantees. Why? And I think Lasita, addressed some of the issues. From where we are today, from a global macro perspective, right? We have, rising inflation, not just in developing countries, but in developed countries. And we saw what's happened, in Europe and in the UK, and even in the US. We have rising inflation. What does that mean? It means that interest rates go up. With interest rates going up, cost of capital is increasing. And with cost of capital increasing, is making it more difficult and constraining the supply of capital, right? So with supply being restricted, demand remains high because we know the challenge in terms of the climate issue that we all face. So, one of the ways that we look at addressing that is obviously how we can access or partner with the private sector, right? We know that from the government or the public purse, that supply is limited. And the climate issue that we're facing, it's an ever increasing cost. It's almost like an avalanche. If you can look at it from a kind of concentric waves perspective, every year it's increasing. The point is, the private sector, as Lasita highlighted earlier on, they have about $95 to $100 trillion worth of assets under management. Currently, less than 2-3% of that has been channeled into climate and impact projects, and a lot of those projects are in developing countries and small island developing states. Unfortunately, it's a function of kind of multiple aspects, that the private sector want a certain return on their money because they're answerable to their shareholders as well as to the contributors, i.e., the pension funds that that will be paying some of our pensions in the future, insurance companies, etc. So they are slightly more risk averse because they want predictable kind of annuity type income. When I say annuity, it's kind of steady, non-volatile or income. So that for them is important. So where there's volatility for them, that is not an area they can play in. The banks, as highlighted by Avish in Barbados, they also have kind of different challenges. They are risk averse, and I think it's not just a problem that pertains to the island states, but globally, banks, the way they make most of their money is through providing debt, right? And when you're looking at an opportunity, you assess the risk, and you assess how you're able to mitigate the risk because your returns are capped based on the interest rates that you charge. Remember that banks mostly do not provide equity. Equity, you take, yes, your downside or your risk is higher, but your upside, the return is also uncapped depending on how things perform. From banks' perspective, that is not the case because they look at, they're providing debt, which is, 3%, 5%, 8%, whatever the interest rate is. So there's slight kind of differentiation in terms of how the different institutions look at the various risks. But our role, GCF's role, is to see firstly how we can help to de-risk projects, right? We are pretty much sector agnostic, although we look at mitigation and more now on adaptation opportunities, right? And by that, we take concessional, we provide concessional funding, i.e., we take a much lower return, and the trade-off for us is that if the climate impact, is significant, and that for us is one of the reasons we exist. We don't exist to, I say this in a caveat, we don't exist to make money. We exist in order to create sustainability, right, in projects that we do, as well as ensure that the climate impact is achieved. So I don't want to, I'll leave it at that. I don't want to go, which is what I'm trying to avoid. I'll pass over to Avish and Lasita.
So you asked, do we have an instrument for this? So the Bridgetown Initiative has as one of its 5 objectives a global climate mitigation trust. We are arguing that we need $500 billion of donor guarantees, of SDRs in a trust in which projects can apply to get this money based on how deep and how fast are they going to mitigate the climate crisis. It's not just the amount of greenhouse gases, but also the pace. So we have a lot of short-lived climate pollutants like methane. So we need projects that are deep and fast at reducing, and then they will get access to the 500 billion, which by using guarantees, we hope to leverage at least by maybe 10 times. Laz has done a great job to get to 16, but let's say 10 times. That's 500 billion times 10, $5 trillion. Now, for the first time, we're talking the kind of scale we need. Developing countries need $2 trillion per year to go into climate mitigation, and we're nowhere. We're not even 10% there. So this is the idea of trying to to get that scale. Now, it doesn't need to be one trust. It could be a trust that is split up in the different regional development banks, the IDB in Latin America and the Caribbean, the African Development Bank here in Africa, and the Asian Development Bank may have regional climate mitigation trusts seeded with these donor guarantees, for which people come and try to bid for, and they bid not for money. They're not using money. They bid using the amount the project can save our climate in terms of its depth and its pace. Thank you.
Oh, thank you, Sonny. So at CLDB Bank, as an alternative source of climate finance mobilization, we are also planning to issue the first green bond in the market. And I would wish to recognize the UK government. We are working at the background with the British Investment International to realize the first green bond in the market. And I would also wish to invite any other interested partners in terms of our wish list on the project. If you have appetite, you are welcome. Tanzania is a huge country. There is a huge opportunities. So we are welcome other partners. If you have appetite, we can extend the conversation. We would wish to raise more than 500 million US dollars. So it's a lot of money. So we can collaborate. Thank you very much.
Thank you very much for those questions, and thank you very much for your participation and in supporting our event. And I'd also like to thank our panelists, Kenneth, Avish, and Lasita. So I think that'll come to a close. And again, thank you very much.